Happy April to you all. It's been a little bit of a while, but I'm going to catch you guys up on some rates. I'm going to catch you up on some goofy loan programs that have come out recently, how your borrowers can benefit from the second look, and I'm also going to cover some credit myths that should help you with questions that borrowers had. So let's get started. Mortgage rates for the year looks like they bottomed out on March 27th. That's when we saw rates actually dip almost into that 3.99 range. We definitely are in that 4.8 to 4.25 range. You can see by the chart, this is the 27th, where we hit this, what's called a Fibonacci level, and rates kind of bounced off that and then worsened overall. Now, it's not too bad of a worsening, and we seem to be in this nice little trading channel right here, which is hovering around this Fibonacci level. What we're going to, and the reason for this is we actually saw some inflationary news raise its ugly head. We're seeing some great numbers come out for the economy. We're seeing some great numbers come out for unemployment. So let's look at those numbers. First numbers that came out was last Friday's, and this was the job numbers. 196,000 jobs, and that was after February's dismal numbers of 30,000. It was just a miserable number, and everybody's like, what's up with this? So the United States economy created 196,000 jobs. Unemployment rate stayed at 3.8%. It's probably not going to budge from there because in order for the employment rate to change, people actually have to report. And the reporting is done by an old-fashioned telephone call survey. And so unemployment rate is actually kind of a bogus number. But what kind of drew up a little bit of inflationary news was the increase of hourly wages and weekly wages. Both hourly wages and weekly wages went up last month, which is inflationary. More people get paid higher. That means the widget that's being made has to increase in its price to pay those, because we all know corporates don't want to cut their profits. A couple other items that came out. That weekly jobless claims is the one I'd really focus in on. It's a fairly accurate number, and 196 last week. Stupid low. They couldn't even find statistically how low it's been in so long. They think it's like been since the 50s or so. But really low number. It's showing that the economy is still strong, and a few weeks back we talked about recession. The new numbers came out this week. Morgan Stanley, a couple other trading houses said that instead of a 20 to 30% chance of recession in the next 2 years, it's down to 10. Great news for us. Another news that came out this week that was really good was foreclosures. And you can see the foreclosures are excellent right now. So people that are 30 or more days past due, we went from 4.9 to 4.0%. And if you look like in the foreclosure, we've gone from 6.6% in foreclosures in 2018 down to 0.4% in foreclosures. And considering that 1/3 of all houses in the United States are paid for in full, we're really talking about a super low number. We're going to continue to focus on this number and the jobless claims numbers to kind of sniff out that potential recession. Moral of the story is rates are not as good as they were on March 27th, but we are still at low rates for lowest rates for over a year. This is a 1-year chart, and you can see that rates are great. So the moral of this story is even though home prices are still continuing to rise, we want to tell our clients, hey, home prices are rising, but rates actually have fallen in the last, probably since November. Since November 8th. This is a great time to purchase. Houses are coming on the market all of 22 seconds when they do come on the market, but rates are fabulous. So get out there and tell people rates are great. I don't often beat on a dead horse, but I'm going to drum this one a little bit more. I highly encourage you that when your borrowers get a loan estimate from another lender, have us take a second look at it. We are seeing significantly higher fees and higher rates by a lot of the local retail shops, and we are smoking them on second looks, which makes you look like a hero because rates go from 3.75 to 3.5. So you saved your borrower a 1/4 point on their interest rate by having us take a second look, and you're saving them probably origination fees. So I have a website set up for the second looks. It is right here. I'll send a link for it. I've seen a link for it before. Kind of describes our second look program. More importantly, I am starting to put my actual second look files on here to show people how we are actually saving people money. And it's a great program. So please, please, please encourage your borrowers to have First Choice Mortgage take a second look. Yes, I am obviously financially going to benefit from this, but you, more important, are going to benefit from it because you are going to make your clients a lot happier with you, that you're looking out for their best interests. We get a lot of questions about credit, and there's quite a bit of myths out there about credit. So I'm going to create a flyer and I will attach it down below, but I also want to cover some of the myths with you. That way, if you get borrowers that ask you this question, you can be educated and be a resource for them on credit myths. So one of the big myths out is if somebody opt-outs, so you can opt out pre-screen, so prevent people from looking at your credit report. That rumor is that if you opt out, you actually get FICO points. That's totally false. The opt-out system is a total separate system that's run by the government, and it has nothing to do with FICO calculations. So busted myth right there. Paying off delinquencies will remove items from your credit report. No. So the rule of thumb is a delinquency or a bad ding on your credit report will be on there for 7 years. They actually could be on there longer. I pulled a recent credit report, whereas somebody's bankruptcy from 1993 was still on their credit report. It's not factored into the credit report, and we as lenders don't really look at it. You know, it's on there, we see it, but it has no factor in underwriting or credit. The other thing about it is if there's a delinquency on a credit report and somebody decides to get it removed, or it's a really old delinquency and pay it off, this actually can negatively affect somebody's credit report. What it does then is the credit collector will actually re-report that collection. And by re-reporting that collection, it will actually adjust somebody's FICO score. All rate inquiries on shopping a loan around will ding your credit report. Total misinformation. There's tons of lenders that will say, well, we don't want you going shopping around because every credit pull is going to ding your credit report. This is a bald-faced lie. So what happens is let's say I pulled a credit report on April 1st. That will ding a borrower anywhere from 3 to 5 FICO scores, and it's called a hard hit. Then for the next 30 calendar days, every lender that pulls that credit report, it does not, and I repeat, does not ding them FICO points. You're allowed to shop for a mortgage for 30 days. Now, after the 31st day, if a lender pulls it, yes, it's going to re-ding them. The other thing about it is for credits, for hard pulls, when we pull a credit report, it's good for 90 days. And the reason why it's good for 90 days is because on your 91st day, the original credit ding that we did on April 1st gets taken off the credit report. So hard pulls stay on the credit report for 90 days. And then we can repull a credit report and won't ding them again. When you shop for a car loan, you have about 14 days to shop for a car loan. That way, if you go down to Kendall Ford, the dealership will shop your rate around. They actually won't shop a rate around. They'll shop around how much money they get among different lenders. And so you're allowed to shop for a car loan or an installment loan, so an RV, a car loan. On a credit card, everyone dings you. So if you pull a Discover card today, that's 3 to 5 points. Citibank card tomorrow, that's 3 to 5 points. Everyone will ding you 3 to 5 points. Sure, you get that back after 90 days, but you can really super drop your FICO score really quick by credit card shopping. Opening new accounts will help your credit score. This is kind of a yes, no. If you have infant credit, which means you're a brand new borrower, you don't have really any credit, and you open a credit card up and you let it simmer for usually about 90 days, you might get some credit scores. But if you have a mature credit, you know, you've had credit now for 20 years, and you open up a credit card, you're actually going to get dinged for those 3 points, and it probably will not affect your FICO score for 90, 180, even 365 days because it has to come up to the standard which you have already set. Paying off a revolving balance is a good thing. This is also false. 2 items on this. First of all, we recommend that to play the FICO game, as we call it, is everybody has 2 credit cards, never more than $1,000 balance, charge $30, next month pay it off. Charge $30, next month pay it off. Or at least charge $30, make the minimum payment, next month pay it off. But by playing that game, you're showing that the credit bureaus that I can have credit, I use credit, I make on-time payments, and I at least pay it off once every 12 months. Super critical that a credit card is paid in full once every 12 months. Another rumor that we've actually just heard real recently is your credit scores are affected by how much you have in your checking and savings account. False. Your bank has no reporting authority to the credit bureaus for having a checking and savings account. On the flip side, if somebody has continually bounced checks and those checks turn into collections, then yes, the bank will report to the credit bureaus on this one. Another rumor is closing old accounts will help your credit score. Once again, no. If you have long-term accounts that you have, you charge on once, maybe twice a year, or haven't charged on it for a couple years and you shut that down, that's actually going to negatively affect your credit score because you have that history. Once again, we recommend 2 credit cards, never more than $1,000 limit, have them for life. The other one that's come up is when a borrower checks their credit score, it dings their credit report. Once again, totally false. When a borrower checks their own private credit scores, it is considered a soft pull at that time. No effect. Other things that are considered soft pulls are car insurance, some rental companies for apartment rents, Quest, Idaho Power, T-Mobile, any of the utilities that pull a credit report, those are considered as soft pulls because they're not establishing credit to you. What they're doing is they're looking for delinquent credits. Next, when somebody pulls their credit report online or their credit scores online, that's what their credit score should be. Totally false. There are actually 69 plus credit scores in the wild. There are credit scores, obviously Credit Karma has a different model. When you go to a car dealership, they have a different model. When a lending or bank institution pulls it, they have a different model. There's a zillion different models. Typically, we see most of the models are off from our models 30 to 50 points. And that 30 to 50 points is a plus or a minus. Now, some of the times, even a blind squirrel finds a nut every once in a while, and the Credit Karma is right on to what we pull, but it's super, super rare. We just don't see that at all. So hopefully these 9 myths you can educate your borrowers with, utilize it for your knowledge. I will also have a link down below with a flyer on these myths. And of course, if you ever have questions, please don't hesitate to use me or one of my loan officers as a resource, and we can get that question answered for you. Thank you and have a great day.